Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, March 13th, 2025. It is 11:34 a.m. Eastern Time, so I'm starting the video. Get a quick one out to you, some of the things I'm watching, key levels to watch, and developments to watch for. All right, so I think at this point in time, I've talked enough on bigger picture. This is a weekly chart. We're well below the 200-day moving averages, which is clearly bearish. We don't have to squint to see it. That's the blue and red line here. We're below this trend line off the 2023 lows. We're below the trading range. So I've had all the sell signals, everything I was looking for to help to firm up the bearish case. In other words, that increases the odds, in my opinion, that my longer term targets will be hit. Somebody asked me when that might be the final target. T7 down there, it's about a 50% drop. My best guess, and this is why in that answer I said this is why I don't trade options. I prefer futures or shares because I always say it's hard enough to get a precise call on where a stock or the market or a commodity is going. That's one thing. It's very difficult to do, and again with precision, it's a whole magnitude of difficulty or extra, if you will, or a whole lot harder to not only say where something is going, but when it's going to get there. But with that being said, I'd say my best guess as early as maybe, that's a big drop. You don't go straight down, but as early as this fall or early winter into the spring of next year, and maybe even later, it could be 18, over a year from now. You can look at previous bear markets, but they're all different. This one has, I believe, a lot of, I think it has risk and excesses that most don't see. I've talked about the what I believe to be a very I don't want to call it extreme, but considerable underpricing of risk in the credit markets. And that's been, we've had credit spreads unusually low, again, based on where I think that'd be. And that's just not because the stock market's a high. I look at things which I've showed you before from my Fred site, the St. Louis Federal Reserve, credit card delinquencies, other car loan, auto loan delinquencies, consumer debt. The consumer has been in trouble. We know that they were, this charts tell me that the spending, and this is where a lot of the economists, they figured, okay, well, consumers can take higher rates. It doesn't matter. Inflation, it does matter. They've been living on credit card debt and being and extended. Again, I'm generalizing, but that is vast majority. And so I do think we can see a pretty quick unwind when it all starts to hit. Traditional metrics that I've used in the past and others have, such as now it's FINRA margin debt. Even the put to call ratios, I believe, have been distorted. FINRA margin debt was, didn't hit the peak it did back before the 2022 top. Only because there's been this huge proliferation or movement into the leverage ETFs. So what that means, for example, other than, I use, I have various brokers, but one of my main trading accounts of my retirement accounts are Interactive Brokers, and I have the luxury of shorting in there. The IRS prohibits shorting stocks and ETFs and things in an IRA. However, they don't prohibit shorting futures. So I'm often able to profit tremendously in those accounts by not just stepping out of the market in bear markets and corrections, but shorting futures contracts, Section 1256 contracts. Those are different than stocks and ETFs. Now, however, where I'm going with that is most people don't, even if you have Interactive Brokers, you heard me say that you probably didn't even know you could do that, but most people don't short in IRAs. But what they now can do in recent years, and we've seen, you can look at the volumes and assets in leveraged ETFs, such as TQQQ, which is the 3-time long QQQ. So it's allowed people that historically couldn't lever up in an IRA account. You just had to buy QQQ. Even if you were, let's just say, financially, reckless, or you weren't diversified, you just plowed everything. You said, I'm going to put everything in the Qs. I have 100 companies. I have the Mag 7, 8, and that'll be my nest egg, and I'll leave it there. And then what happens in a bull market, especially when it gets very long in the tooth and you have a couple years, investors get that perception that those stocks are just bulletproof. They just can't go down because every dip keeps getting bought. And so it's Pavlovian conditioning 101. Buy the dips, bell rings, dog salivates. So buy the correction, dip buyers buy the dips. And I always say buying the dip works great until it stops working. And then so what happens is you can see, look at the volume into this. You can see these are the folks exiting, and probably a lot of them were loaded up. Even if you have a margin account, non-IRA, you can leverage up even more. But in an IRA, so back in the day, if you wanted to go into QQQ, that's what you'd buy. But now you can actually buy $100,000 of TQQQ with a $100,000 IRA, and you're long $300,000 effectively. But yet you only have $100,000. So now when the NASDAQ drops or this TQQQ drops, it drops 37% in just a few weeks. It's people start to realize, hey, maybe these stocks aren't bulletproof anymore. So anyway, I think that's one of the risks of the markets. And again, it's a distortion, of the old. And believe me, margin interest did get very high. And so the beauty of bear markets, what makes them so damn profitable to trade, it's that unwinding of a margin bubble towards the end of a bull market. You do historically, you've always had margin interest at all-time or multi-year highs, and then as stocks go down, selling begets more selling. I've talked about it quite often. And I know a lot of people I know personally were just loaded up and decided to just put everything in NVIDIA or SMCI or MicroStrategy or PLTR, those high-flying stocks, or Amazon, or even QQQ. And that's when that trade starts to go the other way, selling then begets more selling. So, all right, so that's kind of it, state of where everything's at. There's a little line. I'm going to pull this line down here. You can see we're at some support here. In the most important lines, let me just show the levels to watch. And I guess where I was going with that is, so there's nothing right now but bearish evidence. I still think we could see a bounce but I've been saying if this trend line gets taken out. This is the downtrend line, and I'm going to show you a few more. It's very well defined. Pop maybe back to the 200s, test the trading ranges, bottom of the ranges, maybe even cut into the ranges again. We did cut in once before. Remember, we had that initial hurrah off the 200s when we hit them right here. You can see this candle, and then we bounced back into the trading range just enough to blow out some of the stops and suck in some more longs and clear the shorts out, and then that drop came. So there's where we're at. And again, when I look at the just about every single chart I've been covering for 6 months or more, all the developments I've been waiting for and told you those would be check marks, including but not limited to this DH2, talking about a marginal new and divergent high, then a fall back into the range, then a break below the range, and a break of the 200s. You got it. If you follow me, you know what I'm talking about. If you're new to the site, then that's kind of it in a nutshell, but a lot of other things. So now, nothing goes down forever. As I mentioned, we're oversold. I also talked about the fact that don't get too comfy with oversold. It works great. It's excellent in a bull market. So if you have the highest degree of confidence that this is a buying opportunity and the stock market's going to new highs and beyond, this is your opportunity here, just as it was right here. We did buy that one, remember, and right here, I believe we bought that one too. But this one is a little bit different. So I'm still open to this possibility, still leaning towards it, but unless, you've heard me say this a million times, resistance is resistance until unless broken. So that's the trend line on QQQ. Replicate it, comes off the highs, nice and clean. You can see it there on the S&P 500. You want to see the majority of index and market leading stocks break these comparable trend lines. You can see it there as well, pretty well defined. So SPY, you need to break out as well. There's Apple, doesn't have it there, but Apple has big positive divergence. So I'm going to say this too right now. I need to say this because I talked about all the check marks I've had lately and the bearish developments. Everything's playing out according to plan. Things I wanted to see and predicted would happen have happened. And however, you know me, these positive divergences, you have to recognize Apple, one of the market leading stocks, obviously, does have. Now it's what I call potential divergence, just a term I made up. We do have a higher low on the PPO and about equal lows roughly on the RSI with lower lows in price, but it's not confirmed. Confirmed is, in my book, again, it's just a term I made up, when the PPO crosses back over I mean, the white line comes down here, the signal line, then that blue line crosses the signal line to effectively put in a higher trough or a higher low. Then it's confirmed. Now, if we go much lower, we're going to burn through it. And it's not the be all, but it is. It does something I factor in. So now, if that divergence is confirmed on the daily chart, let's go back. The last time we had positive divergence on the daily chart was right here. And the time before that was right here. And we had nice rallies, that rally there, and before all said and done, that rally up to that divergent high, and that was a pretty big move. So the one thing I'll say, and I said this many, many times before, just a few weeks back, I'm sure it was kind of in one ear and out the other for many. I said, if you don't, if you're suspect of my targets are too aggressive or how quick this market can fall, just know that news, the headlines, will change on a dime when the technicals break down. When the market breaks down, all it takes is a 10% drop for sentiment to quickly change. I talked about it yesterday. You got all these big firms now coming out, and all of a sudden they said no recession for 2025, and now they're up to 40% plus on some of the firms calling for a recession. And that can go the other way if we rally. So I just wanted to say that there's a potential for more than just a kickback to test the 200-day moving averages. I do not expect new highs, but we could see if some of these stocks that are just holding on to some key support levels, especially if they regain the majority. Now, the indexes, that's number one. If the indexes regain the 200s in most of these key stocks. Apple's comfortably below the 200s. Let's look at the rest of them. Microsoft looks like toast. It's well below the 200s, but I don't see a lot there. No divergence. It's not, it's obviously one of the weaker stocks. Nvidia, I still maintain very aggressive longer term targets, on the weekly chart on Nvidia that I believe will be hit. And you know what those are. T4 is still my final target. Still below the 200-day moving averages. But when I look on the 60-minute charts and the daily charts, remember the daily, we haven't broken the downtrend lines. But I see quite a few stocks setting up with positive divergence on the 60-minute chart. Not on Apple, but Apple's at support on the 60. Microsoft, positive divergence on the 60. There's a downtrend line. But we're going to need to pop the majority, not one of those trend lines. You can see here, for example, Nvidia popped a minor downtrend line, and it's been rallying, and it's doing okay today. It's one of the only green Mag 8, not by much, because that's a constructive chart and a breakout. Remember, divergence, I'll say it again, I've said it a million times, positive, aka bullish divergence, is not a buy signal. Neither is oversold. They are conditions that typically precede a rally. However, you need a buy signal or buy trigger, which to me is a breakout above a bullish chart pattern, such as a bullish falling wedge or a downtrend line or a horizontal key price resistance level, or even a candlestick bullish reversal pattern. Things like that are buy signals. Amazon, you can see a nice, clean, well-defined downtrend line, positive divergence on the 60. So the potential's there, guys. The setup is there for this market to rally. And where to, let's say for Amazon, for example, if we can break that trend line, that would be a beautiful area to short. You have a mass, that was that topping pattern right there, basing pattern. It would almost be too easy, but if we get it, I think it would be a very, very objective short. And we may never get it. So that's what I do here. I talk about the key levels to watch, developments. So if you replicate these trend lines and simply set price alerts on them, and whether it's tomorrow or 2 weeks from now, you get those alerts going off, and one after another, Amazon and then Apple and Nvidia, and they're all breaking out and QQQ, and then a rally may be at hand. Otherwise, when I look, I see so many stocks. Amazon, look at that, got way above the 200s, straight shot down to below, back tested. Been back testing the last few days and unable to get through there. This is nothing but bearish. If it recovers the 200s, stocks tend to move through them a little bit. So I wouldn't, if it closed right here where my crosshairs are a hair above, it's this trend line it would need to take out to really rally. And if Amazon takes that trend line out, but the remainder of the Mag 8 stocks remain below comparable resistance levels, probably is not going to go very far. Again, I look at these things collectively, and I want to see the majority of market leading stock and or sectors. There's always maybe a red flag somewhere. I'll watch the financials. I'll get to that in a second. Alphabet, I didn't put the trend line, but it's a lot of these top components here have this one's not super well defined, but then you look at the bigger picture. This is a trend line I've been harping on forever and a day off the January 2023 lows. Clearly in not one fell swoop, but we took the 200s out, then the trend line, all this stuff was covered from here, all along the way. Back tested it for about a week, rejected. All this price action here is 110% bearish. However, this is also pretty good support. It's a support zone I had, and Alphabet's holding that right now. And on the daily chart, it's oversold. So again, I'm looking for right now my preferred scenario, and with the buy signal to come, would be a rally back to, let's say, to test the 200s again, or back test this trend line a little bit above the 200s, and if not, I just want to say that as much as we've fallen, let's just look at QQQ for a second. And you might say, wow, Randy. And I point out, hey, we're oversold, the rubber band stretch. But there's times when the market wants to go down, it can go down in short order much more than that. Here's a period. Now, this was a second leg down, but we dropped about 25%. All red sticks. This is a weekly chart. All red sticks without any kind of relief rally. So right now, we're only, when you look at this weekly chart, 1, 2, 3, we're on our fourth weekly candle right there. And so there's nothing to say we can't go down, and oversold can't become more oversold. And look at this. We're not oversold on the weekly chart. We are on the daily, but here's the RSI right here at 39. And this is oversold. This was the last time we were oversold on the weekly, but it was in a bear market, and it didn't do the trick. It was certainly the trick for a nice tradable bear market rally back to the 200s, but the market didn't bottom until we put in a higher oversold reading to give you positive, aka bullish divergence. COVID was a one and done kiss of the 30 level on the RSI. Great buying opportunity, as was the fourth quarter 2018 drop. So just wanted to point that out. That might be where we go before we get the first tradable bounce in the markets. And it's gonna, most likely hinge. And by the way, guys, if we get a breakout above the trend line and then it gets sold in too hard and fail, and you fall back below the trend line, anything more than a back test, that's going to be bearish too. So just keep that in mind. A breakout above the trend line is not a guaranteed, but if you think you're going to rally, then you take it. You take your long entry with a stop somewhat below, and let it ride. And if you're stopped out, but I maintain what I said before. We could certainly go down quite a bit more before we rally, but the risk reward to adding and starting new short positions here, especially with a lot of positive divergence on the 60-minute charts and market leading stocks, it's just not there. NVIDIA, I already showed you the 60. Amazon, I showed you the 60 positive divergence. Alphabet, positive divergence on the 60. Again, not a buy signal. And I don't have a well-defined trend line on Alphabet. Meta, kind of an ugly chart. Meta was up too high, too long, and look at that. Just seemed bulletproof. It was the strongest by far of the Mag 7, and just in a in short order, it's dropped 20%. But there's your nice, clean, well-defined downtrend line. So that's a common theme. So replicate these trend lines. Set price alerts. That way, if they start all going off, then you might want to jump in and engage it on the long side for a bounce. And of course, where to a Meta, you can see a trend line here that might want to be back tested. You can see a price resistance level there. And then I'll, drop down to the 60-minute charts and look at that. Broadcom still, but here's another one. Most of these, this one I call kind of round out to the Mag 8. It's still up there, pretty good weighting, and it's right on that uptrend line and the 200-day moving averages. So if this breaks, it's just another one. They've all, Tesla, we know is well long since broken down, and hovering on that T4 zone right now. But so Broadcom's the last of really to take out their a pretty significant long-term uptrend line and the 200-day moving averages. And so if and when that level breaks, assuming the rest of them don't rally, that's probably going to take it down further. We have a potential, but not yet, bullish PPO crossover, what I call low level. Low level is when you're well below the zero line. There was a low level bullish PPO crossover there. There was a bullish PPO crossover there. They both signified bottoms, turns after corrections. There was a bullish PPO crossover right on the zero line. So that's one thing to watch for. It's been in a bull trend, so you really have to go back to the last bear market to look for. You could see how they did before. All right, let's rifle through the. That's kind of the world of tech. XLK is a tech sector ETF. I mean, nothing but bearish. This is again a chart I've shared many times. October 2022 lows is where my primary uptrend line comes from. A couple reactions there. Just went right down through it. I mean, like a hot knife through butter, which is just outright bearish action. And again, it was priced in. I talked about it for months. And, how these divergences not only didn't get taken out, they just grew bigger and bigger. And typically the larger the excesses get in a market, the more powerful the mean reversion when it comes. And so this is if we are looking at a start of a new bear market, we're certainly off. This one's off to a bang. Or is it just another one of these? Shot across the bow. We were there, short at the highs there. Bearish engulfing candles. We had 60-minute chart to get us in, and it turned out to be a correction. And we did cover. Remember, I thought that initially would have the potential to be the top. But then on August 5th, morning of, I said, no. Covering all shorts, going hard long, because of everything that happened and all the reasons cited back then, including but not limited to majority of stocks hitting either their 200-day moving averages and or key support levels, positive divergences, et cetera, et cetera, et cetera. This time around, I cannot, this is different. There's a lot of long-term. These were shorter-term sell signals on the 60-minute charts and short-term minor trend lines on the daily. My primary, more significant uptrend lines have been taken out now. So it's just a matter of, are you going to get a little kickback rally before we continue much lower or not? And so far today, this market, had another day where it looked like yesterday was okay, but it looked like we could get going today, and they just sold into it. And, even on some relatively good news, I think, from the economic numbers. XLF financials have clearly, there's my primary uptrend line off the October 23 lows. Nice, well-defined trend line. And you don't have to squint to see if that trend line broke down. We're well below it, still above the 200-day moving averages and hanging right above key support around $47. But again, a pretty powerful sell signal. Healthcare, you don't have to squint to see. This is just a beautiful bearish rising wedge pattern. There's your divergence line, i.e. negative divergence. There's your uptrend line. And again, these are unmistakable, clean sell signals. You don't have to squint, say, are you below that line? No, we went through these. I'm on a daily chart, 3 days below. Now there is a little reaction low right here. So, but that's what's going to happen in a bear market, especially if it's going to unwind pretty fast. I'm going to keep pointing out support levels. I'm going to point out the ones that may or may not hold. And the takeaway is, if they don't hold, something's really wrong. Buyers don't step in. It just shows that the supply-demand dynamics have really shifted. And let me give you a few other sectors. The rest don't really matter too much. XLY, look at that there. I mean, come on. These are just beautiful breakdowns. There's a little whipsaw there. But we actually printed back on. That was not a whipsaw because that candle was green and closed back on it. There was our sell signal there. And it started to wobble. And once that level went right there, that 219.88 BOD or first support level below the trend line is just nothing but selling. Now down to a pretty good support level, and but right through the 200 days, like they weren't even there. Very little. We had a little bit of reaction on the first one. So, and again, I'm on daily charts. When I go to weekly charts, they haven't changed for a while. I've been pointing out these big divergences building to the point where most probably figure it doesn't matter anymore. And why is he harping on these big divergences and the negative breadth and things that happened? Again, I spoke to, we had a breadth thrust, which is typical. Remember, couple months back, they started talking on bubble TV, and I noticed it too. The equal weighted and the S&P were doing really good, and they were saying how breadth is improving, internals are improving. That's often a trait towards the end. It's I use the analogy of a dying patient, in hospice or whatever. You get I've heard stories where people have this sudden, somebody's just kind of been in and out of it, and they have this sudden moment of clarity where they're able to, talk and, say goodbye, and everything seems fine for a while, and that's right before the end. I think that happens, and I've seen that happen before in bull markets right at the top. All right, so that's it. XLC communication sector. So I go through these charts. It's hard to find a time frame. Only thing I can find right now are, when I look at, like I said, some 60-minute divergences, some downtrend lines that haven't been taken out yet, but could be and could trigger a rally. But as of now, the trend is clearly bearish. And then, even XLI, the industrials, just until a couple days ago to this week, it, fallen, testing the 200-day moving averages, 1, 2, 3, 4, 5 days, clearly gave them up there. Again, I like to see a solid red candle, 2 additional follow-through candles. So that's the state of the markets right now. So I'll just wrap it up here with my 60-minute chart of NQ, NASDAQ 100 futures. That's probably the best trend line I can do. You might pull it down there, but to give it a little margin of error, I'll come in here, and that's the trend line. So if we can pop that, I still maintain these targets. I still think there's a decent chance, but decent, not great. Believe me, I try to always not just tell you, because to me it's annoying when someone tells you, oh, the market can go up or a market can go down. I'll give you where I think it's going to go, but I'll also quantify or try to qualify, if you will, my convictions, if they're strong or not. So like I said, bigger picture, things are ugly. Counter trend bounce, well, it's going to happen sooner or later. And until and unless we take back a lot of the solidly recover the 200 days, or really get back, I don't care too much about another pop over the 200s if it's brief, less than a week. A solid move back well into the trading range, especially the upper half of the recent trading range we broke down from. That would be concerning to me, and maybe indicate we might be going to new highs. But as of now, I do not think that's likely. And same thing with the smallies, small caps. I gave you the setup yesterday in IWM. That's it. You still have the wedge there. It's just an untriggered trade setup. If you're new to the site, pay attention. There's a huge difference between a trade idea and a trade setup. A trade setup is exactly what it sounds like. A setup that's pending a buy or sell trigger. On a short trade, it would be a downside break of a bearish chart pattern or support level. On a bullish, you need to break out. So the buy trigger here is a break above this downtrend line. And then those are your potential and max targets, the downtrend line there. But an untriggered trade setup is just that. It's an unactionable non-trade. So now, if you think there's going to be a bounce, you can take a position starter, but I would not go full position until we break out there. It just doesn't make any sense. All right, let me wrap it up here, get the video out to you guys, and I'll continue to hunt. There's a ton of trades I've shared recently, I noticed, that have hit price targets, and I just haven't had time to update those. Kind of taking some time off this week, as I told you, but I will do that. But again, if it's any trade idea that you're in that they've been covered, you can find them on the site. You can see what the targets are. I haven't changed any of those targets, so make sure you have price alerts or sell or buy to cover limit orders at your preferred price target or targets, whatever that is. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.